Hello, students. I want to talk about IRA accounts and Roth IRA and SEP IRA. And I asked ChatGPT to create some notes for me. That way, it's just like a PowerPoint. And therefore, ChatGPT is very helpful in terms of, I could go to PowerPoint and I could transfer these, but these are as readable as they are in PowerPoint, and they are nicely bullet pointed. And we go and talk about what these are and what it says. I asked ChatGPT, tell me about different types of IRA accounts, because we have 5 different types of IRA. And how much can we contribute to our IRA every year? And if I have my own business, can I open a kind of IRA account? And here are first different types of IRA. One of them is called traditional. And this kind of IRA is, let's say I work for McDonald's and I make $7,000, let's say $10,000 a year. Out of that 10,000, imagine I am under 50 years old. Out of that $10,000, the federal government allows me to put $7,000 of it in a traditional IRA or even Roth IRA. We will talk about that later. In traditional IRA. And why do you think the federal government is not allowing me to contribute more? And what are the benefits of contributing to this traditional IRA? And one question you have is that how can we have a traditional IRA? The answer is very simple. We go to a brokerage account or big banks. It's better to open it with big banks, or major brokerage, firms that operate very much like banks. They have their own bank as well, and very simple. They are online. You can go there and open, and they ask you what kind of account you want to open. Let's say Charles Schwab, Fidelity. And then you say you want to open a traditional IRA and you have worked for McDonald's, you got 10,000, and the federal government tells you can contribute up to $7,000 because you are under 50. If you are over 50, the government is nicer to you. It allows you to contribute 8,000. Now, what are the benefits of this? Imagine that you are, let's say, 30 years old. What are the benefits of, contributing? Even if you are 50, 60, what are the benefits? Is that, first of all, when you put your 10,000, you make 10,000, when you put $7,000 in traditional IRA, the federal government deducts the $7,000 from your total money, which is $3,000. Now you are going to pay only taxes on $3,000. You won't pay taxes on the $7,000 that you are putting. That means the government is giving you a break. And I intentionally brought the issue of 10,000, but let me make it more clear. That way you have a guess of tax consequences as well. Imagine you make $40,000. You work, for example, for McDonald's. You are a manager of McDonald's. Imagine they give you $40,000. Out of those $40,000, you put $7,000 in a traditional IRA. You open an account with Charles Schwab, very simple, online. You go, and I have one student already mentioned he opened, and several students. Then what happens is that when it comes to file your taxes, your 1040 form of every year you file your taxes before 15th of April, for example, asks you, did you contribute anything to traditional IRA? Your answer is yes. It asks you how much. You say, for example, 6,000 or 7,000. What happens is that then the IRS would say, imagine your name is John. It says, John, didn't make $40,000. This John only made $33,000. That means the government is trying to give you a discount. What is the discount? Discount is the taxes that you have to pay on $7,000. Now the government doesn't look at it as if you make $40,000. Now it says you make $13,000, which is a great deal because you paid not much less taxes. Let's not forget, if you had the taxes you pay on $7,000, you know how much it is? It is, assume that it's around $1,500, which means you are not giving that $1,500 to the IRS. You are keeping it in your account until you become 65, until you become 70 years old. Imagine how much money that $1,500 this year is going to bring you in the next, 40 years. Because it will stay in your account. If you are smart, you will put it in some accounts, that you earn interest of 14%, 20%, I mean, interest, they won't give 15, 4%, or 3%. Or if you know how to invest, you have $1,500 that you had to give to the IRS on your taxes. You did the smart and you kept it in your own account. Guess what? You can save the same thing next year as well. $1,500 next year when you file your taxes. Each year you can contribute. Imagine that how much money will be in your account. Just that is the $1,500 that you had to pay to federal. You have to pay to a state also. Therefore, when you pay to a state, why should you give your money to a state while you can keep it another $500, $400, $300 in your account? It will stay for you. You have $1,800 until the end of, until you are 73 years old. Why not? Therefore, that is the benefit of opening a traditional IRA. And let's not forget, not only you are not paying your taxes, let's say $1,500 in taxes, you are also putting additional $5,500, because if you subtract $1,500 from $7,000, $5,500. Now you have $7,000 for investment. And if you put that money in your, let's say in mutual funds or buy, these products are very easy to, buy. We will show you, we will talk about it. And when you buy them and you invest this money, it will grow. Hopefully by the time you are 60 years old, 62 years old, you will be, hopefully, you will have a lot of money because you are contributing, significantly every year. And if you are wise and you know how to invest, don't be surprised if it turns to hundreds of thousands of dollars or even millions of dollars. Therefore, you have to be, you have to know about it. Where does the name of growth tax deferred comes? Means the IRS didn't get that $1,500 from you. It lets you to have it in your account until you become let's say 60 to 73 years old. Therefore, at that time, IRS wants its taxes. Say, oh, we did you a favor. We let you keep thousands, because over the years, you won't pay a lot of taxes. Then, if your portfolio grows, let's say to $1 million, you sell that at that time, then IRS says that, okay, now give us our taxes. Most likely at that time, the IRS wants $200,000 of taxes, and you will be a happy camper. Why? Because you didn't pay almost $50,000 of taxes to the IRS for a period of 30 years, 20 years that you contributed $7,000 every year. And that $50,000 had brought, because you had to give that $50,000, had brought, let's say, as much as $600,000 for you. Of course, that the other money that you have put also contributes. Let's assume it grows hopefully to $2 million. Then because you didn't give $50,000, $60,000 of money to the IRS and kept it in your account and invested it, and you made a lot of money. Of course, if you lose any money, the IRS can't get anything from you because you didn't make any money. The IRS wants the money when you make a lot of money, and then you have to pay, of course, the taxes. That's why it is called, it grows tax deferred. If next year, let's say $50,000 goes on top of what you have put in your Roth IRA, traditional IRA, the IRS doesn't come to you and say, oh, you make money, now you have to give us, our taxes back. No, it says the IRS can wait until you become 73 years old. Do you see that? That's when it comes and asks you, okay, it is time that slowly you give us the money. Therefore, why not? If the IRS wants to give you $50,000-$60,000 of taxes back, therefore, and that's how you get the money back for, when you contribute to your traditional IRA. Therefore, gross tax deferred, that means that rather than paying your taxes of $40,000 that you made in McDonald's, you paid taxes only on $33,000. You didn't pay taxes on $7,000 that you put in traditional IRA. Then, when you become at the time when IRS says, okay, we were nice to you, now you have to pay our taxes back. You are 73, taxed as ordinary income in retirement. When you retire, let's say your portfolio is $1 million, and then you go and you decide you need $100,000. You withdraw $100,000. IRS says, okay, this $100,000 is an income that you are taking, and then okay, it's just like an ordinary person who works for an employer and gets paid $100,000. The IRS says that okay, now $20,000 is the taxes you have to pay us, and the state of West Virginia also wants its own taxes. Therefore, your smart strategy is not to pay taxes to the government and keep that tax in your pocket. And the second strategy is to let it grow as much as possible by understanding the investment and by understanding the risk and by understanding the interest rates and tax concepts. The more you understand these things, the better and more, more money you can make. Therefore, taxed as ordinary income, then it calls it required minimum distributions, RMD. Which means the IRS doesn't ask you, doesn't call you, doesn't want any money back, doesn't want its taxes back from you until you become 73. When you become 73, the IRS makes the assumption that let's say you are going to live, up to 100 years old. They say from 73 to 100 is 27. Therefore, imagine you have $2,700,000 in your Roth IRA, the IRS divides $2,700,000 by 27 because it says you live 27, years. That is $100,000 a year. The IRS comes to you and forces you and tells you, hey, you cannot keep this money and our money for the rest of your life. We need our taxes back. At that time, it forces you to pay $100,000 every year. Because if you pay $100,000, by the time you become 100 years old, you have drained all the $2,700,000 out. When you sell $100,000, imagine when you are 73, out of that, the IRS gets, let's say $20,000. The state of West Virginia gets, let's say $5,000. That means that money goes out because they were nice to you. They didn't, they gave you a break. Now on your 73, when you are 73, you have $75,000 in your pocket because out of $100,000, you gave $25,000 for taxes. The rest of it is your money. You keep it, and then next year the same thing again. You have to withdraw $100,000. By the time you get to 100 years old, by that time, let's say that money is depleted. Of course, IRS works with you to make sure if you live more than 100 years, you are not, your account is not empty. But that's how the traditional IRA works. Many people likes this traditional IRA because they feel that they are getting their taxes back. Therefore, convincing the IRS that rather than charging taxes on $40,000 of work at McDonald's, to charge them $33,000. If McDonald's has been withholding taxes on their paycheck for assuming this employee is making 40,000. When your accountant fills out the taxes for you, it asks you, did you put anything in your traditional IRA? You say yes. Then your employer, with the accountant, when fills out that 1040, tells the IRS that this person has put some money for the for the Roth traditional IRA. And in that case, if you are getting your checks back from IRS, you will get a bigger check because it says McDonald's was not supposed to keep as much as 40,000. It had to keep the taxes for 33. Therefore, you will get, if McDonald's has not, doesn't know about how much to deduct from your taxes, you will get a good check back from the IRS. That's why the IRS also doesn't allow you to put more than 7,000. Why? Because IRS loses its money. It needs taxes to make, it needs money. If they don't, they let you put, suddenly you might be a smart person and you might be, from a rich family. You will put all your $40,000 in the Roth IRA because it is a traditional IRA. Because everybody likes to contribute to the IRA, Therefore, it puts limit to make sure that the people, don't force the IRS to go bankrupt by putting all of their money, because it's a great deal, That's why, it is important for the students to understand the concept of contributing to the IRA. Now, we go here. While I am here, I want to show you how easy it is. I will go straight to Schwab and let's see if I can go to Schwab, and here it is. Schwab. Oops, it went to SSA. Oh, this is Social Security government. I strongly recommend become familiar with this. If you have parents, some of your parents already know what this is. Sign in. If you help your parents, some of them don't know how to go in here, sign in, and see very good numbers. My recommendation, we will talk about it at some point. But for now, let me go to schwab.com. Okay, when I am in Schwab, I would say I come here, open an account. Do you see that? Open an account, and then I click here, and it asks you what kind of account you want to open. Look at, there are 3 types of IRA here. We will talk about it. One of them that we just talked is this traditional. And then individual brokerages is that's when, it's not right. It's just you have some money you want to, invest in stocks. Do you see it's written stocks? You open that one. But if you want, this is called tax advantage account. That means you take advantage of the IRS. Why not? If you can take advantage of IRS, means that it helps you. This one in terms of taxes. Therefore, what does this rollover mean? We will talk about it also. And of course, individual is that, imagine you might say you don't want to put anything for retirement, because on this one, you have to wait until you become, on traditional IRA, you have to wait until you become 59 and a half years old. And at that time, you can withdraw your money from, that traditional, you can withdraw. What happens if you are 30 and you become, at age 32, you decide to withdraw the money? Let's say you have put $7,000 and next year you run out of money and you want to liquidate your traditional IRA. What happens? The IRS says, hey, we were nice to you. We didn't get the $1,500 taxes from you. Therefore, you pay you haven't done anything wrong if you withdraw, your money at age 32, for example, or 31. What happens at that time, you sell it, the IRS wants the taxes. How much taxes? Most likely $1,500. State of West Virginia comes and says that, okay, we didn't charge you tax, give us the taxes. State of West Virginia think about once it's $500. Therefore, out of $7,000, you end up paying the taxes that you were supposed to pay, but the IRS is smart, wants to encourage you to keep the money until you are 59 and a half at least. What it does is that if you get the money, that $7,000 out, we will charge you 10% interest. What is 10% of $7,000 is $700, which means the IRS not only gets this $1,500 and the state gets the $500, which is $2,000. Rather than giving you a check for $5,000 after the taxes are deducted, they deduct $700 as a penalty for early withdrawal. On this one, you cannot withdraw early. You have to wait until 59 and a half. But if you want to withdraw early, you can, but you have to pay the taxes that you didn't pay, and you have to pay 10% penalty. Therefore, don't think you have done anything illegal if you sell this. It's just a rule of the IRS, numbers of the IRS. It penalizes you by 10% because IRS wants to encourage you to think about your future and your retirement. They put that penalty there to discourage you from liquidating your traditional IRA. Therefore, that's what, this is one kind of IRA. Now, a lot of people like this Roth IRA, particularly those who have a lot of years left up to age, 60, 65, and so on. Therefore, for this Roth IRA, many people, as I said, I encourage many students to open this Roth IRA, and I encourage some to open traditional. Why this Roth IRA is also a good deal, and for many students, this might be a better deal. We go to the same concept of an employee who, works for McDonald's. This employee makes $40,000 and then puts, because he or she is under 50, imagine it can put 1,000 or 2,000, but if he can manage or she can manage, can put $7,000 here. If you remember, in case of traditional, IRS looked at this person as if he or she made only $33,000. It gave them a discount up front. But here, the IRS doesn't give you a discount up front. What happens is that you put the money in here and $7,000. What happens is that this $7,000, you already paid taxes on it. That means its original amount was around $9,000. But because you in McDonald's, you made, $40,000, out of $40,000, you see that, okay, you have $9,000 of it, you can invest, but of course you have to pay taxes when you make $40,000. Then you pay the IRS taxes. When you pay state taxes, then there's $7,000 remains. You put this $7,000 here, and every year you contribute this until let's say age 62, 65. When you come to the age of 73, imagine that it has reached again to $2,700,000. Now you have to withdraw. IRS, that doesn't have. In that case, you do not have required. IRS cannot tell you go ahead and every year sell, some of it. Why the IRS can't tell you is because your answer to IRS would be, it's not your business. I already gave you your taxes up front. When I made $40,000 in McDonald's, I didn't say I contributed to the traditional IRA. I contributed to Roth IRA, and like an ordinary person, I had paid my taxes on that $7,000. Therefore, that was my own money. I didn't put your taxes, the taxpayers' money, in this Roth IRA. Therefore, everything in this IRA is yours up front and at the beginning. Therefore, when you put your money in here, when it becomes $2,800,000, $7,000, then if you decide you can take $100,000 of it when you are 73, what do you think the IRS can tell you? The IRS won't be able to tell you anything. They can't touch your money all $100,000 is yours. You don't pay any taxes. Why? Because your argument is that I paid my taxes. It was not tax deferred. You paid it up front because you have paid your taxes just as you pay every year. You have paid your taxes up front. Therefore, it's not the business of the IRS to force you, to pay taxes. Therefore, the whole $2,700,000 is yours. Also, it cannot force you at 73 years old. You sell your $100,000 of your portfolio. That's called minimum distribution. Because your argument to IRS is that I don't owe you any taxes. For this one, IRS charges, forces them to liquidate $100,000 of it because IRS says we didn't charge you taxes. Our taxes were in your hand. Now you have to pay. So you cannot keep it up to your age when you are 100 years old. We want our money back, our taxes back. If anytime you sell them, you have to pay us back. But at the same time, you have to sell something every year until you become 100 years old. And by that time, they want all the taxes that they are. That's called tax deferred. But many people like this one. Why? It is called made with after-tax dollars, and which means it is not deductible. Here it was deductible. Do you remember that we said you tell IRS, your accountant will say that you made 33,000, not 40,000, because that was tax deductible. Here is not tax deductible. You don't have any deductions from your taxes. It's just the regular $40,000. Earnings go tax-free, which means the earnings means anything it goes up, it is free. But guess what? On this one, imagine you put $7,000. Next year, you try to withdraw the money. The IRS cannot tell you they are going to charge you taxes because you have already paid it, Therefore, that is also, it cannot charge you penalty because you are telling the IRS that, you have already paid your taxes up front and it is not the IRS business. There is a rule that on your earning, the IRS can charge you, not taxes, they charge you some fees if you sell them early. The IRS also wants to encourage you to keep your money. Therefore, next year you try to take your $7,000 out when you are at 31 years old. You can take the money out. The IRS doesn't say anything. However, if you put your $7,000 and it became $8,000, now you on your $7,000 that you can take money out, the IRS doesn't tell you anything. On that $1,000, if you try to take that $1,000 out, the IRS wants taxes from you on that, wants a kind of penalty on that. Because it says, why didn't you wait for, age 59 and a half? That's the minimum time that you can, earliest that you can withdraw. Do you see that? On the growth of your money, if you withdraw early, you have to pay taxes. But you won't pay taxes on that 7,000 because that 7,000, already the taxes for it were already paid to the IRS. Therefore, that's why it is called after tax, gross tax free, and qualified withdrawals. After age 59 means we qualified withdrawals. Qualified is that when your $7,000, imagine, becomes, 100,000. Imagine, it grows. Imagine you didn't put anything else. It goes from 100,000, 7,000. When you are 60, let's say 59 and a half, it goes to 100,000. You can easily withdraw the $100,000 because, as I said, you can take your $7,000 out anytime you want without any penalty. And also you can take the rest of it. That means the whole $100,000 if you are 59 and a half, which means that the IRS cannot take a penny from you. That's why the IRS wants to keep all your profits in there. That way you can have a good retirement. That's the purpose of IRS, putting a kind of penalty of maybe 10% because on the growth of your money, not the money you contributed. As I said, you can always take the money out, the money that you contributed, but the smart people never take that money because everybody wishes that he or she could contribute to this Roth IRA. That way their $7,000, become $100,000 at the, when they are, at 59 and a half. And also it is, as we said, it is tax free. There is something that says after 5 years after first contribution, means that if you open, if someone is, let's say, 49 years old and puts 7,000 for the Roth IRA, and then next year the person can take his or her $7,000, but if his or her investment from 7,000 becomes 8,000, then to get that extra $1,000 out tax-free, he or she has to wait for 5 years of opening his or her Roth IRA, because that person opened it at age, what is that called? So at age 58, I should have said. At age 58, had to wait 5 more years until he becomes or she becomes 64. As I said, this person who is 58 at any moment can go and get his or her $7,000 out. Only that $1,000, the IRS says, hey, you just recently opened. Well, that $1,000, if you want to get it, you have to wait for 5 years, But that's why it is a good idea to open Roth IRA as soon as possible. That way, this time period of 5 years passes, And also, it is a good idea to wait until 59 and a half. And if you don't wait and you take your profits out, the IRS gets 10% penalty. But this is something I highly recommend, particularly if you are around 30, 40 years old. The younger, the better. Too many years old, it grows tax-free. And I sent you an article about that guy, yesterday, Peter Thiel. I hope you read it. He put $2,000, is $2,000 is now, $5 billion. Can you imagine someone being, and it is tax-free. If he had put his $2,000 on this one, if he wanted to sell his $5 billion, his tax rate most likely would have been 36%. 36%, because it's a lot of money. You sell it, you are rich. 36% of $5, that is $2 billion almost. That means his $5 billion now could be $2 billion. Now it could be $3 billion, because $2 billion would have gone for the taxes. But that guy, the $2,000 he put in his Roth IRA, he had paid his taxes, $500, $300, $400 taxes he had paid, and that $300 or $400 saved him $2 billion of taxes. That's why understanding taxes, how they work, is extremely important for becoming a wealthy person and for becoming allowing the money to grow. Therefore, one of your goals is that you find a legal way to not to pay your IRS, taxes as, legal way. When we say is that you, of course, as a business student, as an accountant student, you always have to be honest with yourself, with the IRS, with the employers, with the employees. Those who are honest and, file their taxes clearly and correctly, over the period of time, they make more money than those who try to cheat. There are people who cheat and try to file, faulty taxes. These people, at the very end of the, end, they will be less, they will make less money. On top of that, if they don't get even caught, they will make less money overall. Statistics have shown, that the businesses and the people who are, working ethically and who, file their taxes clearly, nicely, everything is honest, then they will make more money. Therefore, but at the same time, you have to learn about the tax laws. IRS wants you to pay them as less as taxes as possible. That's why it is encouraging you to put your money here. It is encouraging you to put, when you put your money $7,000 here, you know who the loser is here? The IRS, because the IRS, because your money is growing so, and then the IRS doesn't get, anything. If your money from 7,000 becomes 1 million, and you sell it, the IRS doesn't get any money. But on this one, imagine here is brokerage. If you wanted to put your $7,000, this one, let's say, in the case of the McDonald's, you make $40,000, you pay taxes on it, and then you put 7,000. If this 7,000 becomes $2,700,000 after, after 50 years, 60 years, you sell it, you have to pay taxes to the IRS as well, because you made money on that. On that 7,000 that you put, the IRS doesn't charge you taxes because that's your own money that you had already worked for McDonald's and you paid, and you had it, the money was in your checking account. Usually the way to think about it, the money that is in your checking account, usually that is after tax money because you have worked for it and most likely your employer deducted taxes. Therefore, that's your own money that you put in here. Of course, this joint account most likely, is that, for the family. And we will talk about rollover as well. The rollover is that many of you have a 401k. Let's say you are working for McDonald's, and the McDonald's, gives you 401k. Many of you have it, you have heard of it. Now you quit McDonald's and go and work for 7-Eleven. Then what happens to the 401k that you had? That 401k in many ways, is similar to this traditional IRA. The difference is that this is something you open, usually you open, but this is the 401k is something usually employer opens, puts money on it on your behalf, you contribute some. When you leave McDonald's, then you are free to do whatever, usually, you are free to do whatever you want to do with that 401k. When I say free, doesn't mean you can sell it, because if you sell it again, you fall into the same category of 59 and a half, and there was a 59 and a half. IRS says that, oh, we were nice to you, we didn't get taxes from you. If you sell or you do this, we want our taxes back. Therefore, that has a lot of features similar to this. The difference is that this one, usually you manage this one. You decide where to put to Charles Schwab. But in terms of the IRS, in terms of the 401k, you leave McDonald's. You don't want your money to stay with McDonald's because you say you are not working for them anymore. And McDonald's usually can't say you have to keep your money in our brokerage. You say, no, I have an account with Charles Schwab. I want to transfer my 401k to Charles Schwab. Then you come here and you open a rollover. Means you are going to roll over your 401k to in here, which is called, rollover IRA. In this case, then what happens is that, IRA, the McDonald's has a brokerage, has an, banking that is associated with McDonald's. They give you a number. They say, this is our corporate number, call them, and this is the department where your 401k is. You call that department and say, hey, I have opened it, a retirement with Charles Schwab, and I want my money to be transferred to Charles Schwab. Then they say, okay, what is the address? We will send Charles Schwab a check because your 401k is, you have $10,000. Then McDonald's sends a check in your behalf, to traditional IRA. And in Charles Schwab, they tell you what number it is. It's just like giving you your account number. You give it to, McDonald's. Then McDonald's sends a check. This actually is, I think, in Florida, the branch that receives the checks. As soon as the check goes from McDonald's to the, Charles Schwab, and you already have your rollover, then your money comes, and now you have your money all at your disposal in here. Therefore, sometimes it's a good idea to have things in, one account. As I said, you cannot get your 401k out of McDonald's unless unless you quit McDonald's. Usually they want you to stay from there. And also, when your money is there, your money, when it is in 401k, they are kind of restricted. You won't be able to, most of the time, to buy individual stocks. You will get a basket of stocks that they put it for you. People talk about 401k, 401a, but for now, you learned about three kinds of, IRA, and we are going to talk about one last one, is that you imagine that you are not working for McDonald's. If here is written no RMD during lifetime. Do you remember here we said that RMD, when you get to 73, IRS wants its taxes. It tells you required minimum. You had to sell $100,000 every year. Here, IRS cannot force you to sell it. You would say, oh, it's not your business. I have paid my taxes and you cannot force me to sell. I'm 73. I want to keep my portfolio and let it grow. Therefore, that's called no or required minimum distribution, RMDs. Then we come here, SEP IRA. Let's say I have my own mechanic shop. I am not working for McDonald's, Can I contribute? Yes. Therefore, I go there and I call Charles Schwab and say, can you open a SEP IRA? I have my own, mechanic shop. They say, okay, they will open it for me. And it allows you, look at here, much higher contributions than traditional or Roth. Do you remember here we always talked about $7,000 you can put either here, or you can put half of it here, half of it here, 7,000. If you are under 50, if you are 50 or over, the IRS is nice to you. It lets you put $8,000 a year instead of 7,000. Therefore, here it limits you by how much? $7,000, or if you are 50 and under 50. But here, do you see? It has much more contribution. Where is that? Here it is. Your question would be why this SEP IRA has much more contribution even if you are your own employer. The reason to it is that if you work for McDonald's, most likely they let you put for your 401k. Do you see that? Therefore, the McDonald's has something special for you. When you work for McDonald's, you have two options. You can choose both of them. Contribute to your IR 401k and also contribute to, this one. Therefore, you have two great options. You can use both of them. But this poor guy that works for his or her mechanic shop here doesn't have 401k. IRS feels sorry for this person. They say, okay, we don't limit you to, what is that called? To only $7,000. That's why you can put much higher than 7,000. They put some limits, most likely they let you to put $25,000. Depend. They have some, tables that you can. Therefore, if you have your own business or your parents have their own businesses, can they have IRA? Yes, they can have IRA. They can put their money. They don't need, but it is called. They can open an account, and it's for their business. The purpose. Also, if they can open. Let's say if your parents are making $7,000. They can still open this Roth or traditional IRA. But the IRS can tell them if they want to put more, then they will go and open a SEP IRA. And in that SEP IRA, they will say that, hey, we don't have 401k. Because we don't have, we want to, contribute more. Even if you work for this employer, I believe for this mechanic shop is small. It cannot open 401k for you. Usually 401k is more convenient for bigger employers. Therefore, because you are an employee of this mechanic shop and you like to contribute $20,000 to your retirement, and therefore you can put only $7,000 according to this. You can put maybe $7,000 here, but you can open this one and put the rest of $13,000 here. That way the IRS is nice to you to make sure it is not discriminating between you that have your own business or employee of a small business of a mechanic shop, you can have as much benefit as the employee who works for McDonald's or chicken plant or other employers who provide 401k. 401k itself has some limits, because if it was not like that, billionaires could go and put their $1 billion every year they put it in, then because a billionaire has to pay, let's say if someone makes $1 billion now, has to pay 300 million for taxes. If the IRS allows people to just put the money, $300 million taxes is out of hands of the IRS. Therefore, they put a limit. How much they put a limit on 401k? If you are working, most likely your employer say it is $23,000 maximum you can put. Therefore, there is another one which is called simple IRA, and that is saving incentive match that the employers, small employers less than 100, and both employees and employers, and easier to administer than 401k. Therefore, it's very similar to SETA. These are not the contributions. If you work for McDonald's and you are, or for let's say a mechanic shop, still you are an employee of a mechanic shop, you can put up to $7,000. If you are 8,000, if you are over 50, and Roth phase out at higher income. The meaning of it is that the IRS doesn't want the very rich people put their money in here, because the people can put significant amount of money in Roth, and that's significant. You remember that guy who put $2,000 and converted it to $5 billion? If he was, if the IRS allowed him to put $1 million in that instead of 2,000, that would be suddenly $100 billion. Therefore, if you are a rich person, you make $400,000, IRS says, sorry, you cannot put your money here for the Roth. You can open traditional and put 7,000. This is for the people usually who make $100,000 or less. Let's say if you are 100,000, it has a rate. If you make less than 100,000, you can put maximum of 7,000. If you make more than that, then 110,000, IRS say, oh, we don't let you put 7,000. We just let you put 6,000 here. If you want to put the rest of them, put in traditional IRA. And SEP IRA has, that we said it's for the mechanic shop, up to 25% of net self-employment earning, which is a great. That means if I make, let's say, $100,000, I can put $25,000 of it in that SEP IRA, capped as $69,000 per year in 2004. What it means, I believe, is that I can put up to $69,000 in my SEP IRA, and then if I cannot put more than that. Do you see that? Therefore, I don't think, employment, and I believe this is how much the person can contribute rather than this is the income. Because if this is the income, that would be 25% of it would be almost, would be 18,000 maximum. But I am assuming that this is the maximum. That means that rather than 17,000, this person can put 69,000. I can ask ChatGPT. Let me tell you how I would. It takes time, but I will figure. I can go and ChatGPT and say this 60 by this 60. Mind, let me while you are here. Let me see. Here you go. I go in here, and I go to ChatGPT, which I have put it here. Okay, and then I paste it here. And then I say is 69 max income or max contribution. ChatGPT understands, and it will tell me that good question. It says the contribution can be okay. The 60, no matter how much your earnings are. That means you can make $1 million. Therefore, this is great. Up to $70,000. If I make $1 million, I can put us up to $69,000 in it. Therefore, do you see in this course any questions you have, anything you don't understand? You go to ChatGPT and ask. These are and the withdrawal rules. It's becoming a kind of longer lecture, but I finish it in a few minutes. I want you to see this limits that they say. Here you go. Simple Roth IRA withdrawal rules. It says that you can take your $7,000 anytime, tax free. However, when you make earnings on that, that means when your stocks go up, then on that, if you decide to sell those, you can take anytime, as I said, your $7,000 out. But if your stocks have grown on that profit, let's say on that interest, let's say you put $7,000, you earn $2,000 interest. That interest should stay in your account until you become 59 years and a half. And then we said at least the account had to be open for 5 years until you can take that $1,000 of interest out. Your $7,000. No qualified withdrawal. If you take that $1,000 interest out, you have to pay 10%. However, at any time, if you decide to, buy a home, IRS doesn't penalize you. Do you remember we said you have to wait until 5.5 that you take your $1,000 profit out? But here, if you want to buy a house, IRS says no problem if you want to buy a house, or if a person is disabled or certain educational or medical costs, IRS doesn't, Therefore, if you have any questions, I want you to go through this lecture. Next week, I am going to give a discussion or maybe an assignment about what we discussed here. But what I said, if you go through, if you understand what we are trying to say, what I am trying to say, these are important things for your retirement, to become a wealthy, to become a, good, to understand finances. And therefore, if you have any questions, as I said, I already contribute. 2 students are getting, one of them already got, $50 from me out of that 500. I saw that a student somewhere in a shop yesterday. I gave him a check for $50, but you are not here. I don't see you, the rest of you in the shop, but we will talk about it. Another student sent me an email, said he wanted to participate. I sent him $1 through Zelle and to make sure he received it. And then as soon as he confirms that he received it, I am going to send him $49 more. And, these 2 students are ready to go. We will talk about it. For those of you who are interested, I'll put a discussion post that you tell me that you are interested. Next week, you will see that. But keep this lecture, and I will post it on the discussion board of next week. That way, I will ask some questions, and maybe I create an assignment for you. The more you know about these things, the better investor you are going to be. Have a good weekend.